Hey there, welcome back to another episode of My Risk Advisor. And today we're going to be talking about pricing shenanigans, pricing changes, pricing discounts, all things pricing, where Zurich have come out with some new pricing stuff going on. So join with me again, Trent Bacon. Thanks for joining me.
Thank you. This is going to be fun.
Yes, this will be a fun episode. So I want to talk about all things pricing. Insurance premiums, there's two guarantees in this world, death and taxes. There's actually three: death, taxes, and insurance company increasing their premiums. What I want to talk about today is a number of things. Repricing, what does it mean? How does it work? I want to talk about discounting, insurance companies discounting their premiums, and then just some creative pricing strategies we've seen. And I use the term creative loosely. Let's start off because there may be people listening who don't do much risk, maybe new to the industry. So talk about what is repricing, how does it actually work?
Yeah, so to start with pricing, you've got to look, the insurers are looking at pricing their policies up for the next 30, 40 years at times. It's looking at what it costs today and what it should cost over the next 30, 40 years on factors that they know today. As things change, as the world changes, the pricing model needs to change and will change, and the insurers will come back and go, actually, we got it wrong a little bit there or here, and this is how much the needle's needing to move to make sure that we're still profitable, still able to hold these policies long term.
You know, we're seeing heaps of re-rates all over the industry. We've seen it for 5 years, and so people have been around for a while. Just continue to see the same companies re-rating, and it's not just one company is doing it; they're all doing it. Let me touch on a few advisor reactions because I've got some opinions on this. I've got some reactions from the My Risk Advisor Facebook group because when there is a pricing change, we get an email, but sometimes it's not super clear in the email. So if you're like me and just skim through the email and go, that's just another update that doesn't really impact. Unless you're really looking into it and clicking into it and working out, okay, what are the actual premium rises, you may miss it. So it is good people are talking about the re-rates in their Facebook group, but often we get this similar comments. So there's some comments like, at what point do advisors just walk away from providing risk advice? It's an unsustainable industry and it's on its last legs. Another comment is, feels outside looking in brackets, I don't write risk anymore, that it's genuinely unsustainable and simply less lives will be insured. Where does this end? So talk to me about the frustration advisors are having. They're the ones talking to their clients and getting those phone calls saying, what's going on? Why are my premiums always going up? Talk to me about kind of your reaction when you get clients calling you up and wanting to talk to us about re-rates.
Yeah, it's never a conversation you want to have. It's obviously one we need to have. Yeah, part of it is we're losing more clients out the back door to insurance. They're cancelling their policy and we're not bringing new clients in. So we need more people writing risk so that these conversations don't need to be had as often. Yes, the insurance companies can be pricing their policies better, but as we know, people get things wrong, things change. Lifestyles and the general public and how people live change, and that needs to change over time as well. So having those conversations is important. Getting on the front foot and talking about it when you're actually setting up the policy as well is a massive thing. 20 years ago, there was no such thing as re-rates, and people, they say, look at the premium projections and it'd be set in stone. It's not really the case, hasn't been for a while, especially when you look at upfront discounting, other things we'll talk about. So getting on that front foot and not being reactive to those emails coming in is going to be your best bet.
Yeah, and I think that's, we went insurance only in 2021, and so re-rates were already starting to happen then. I mean, they've always been able to happen, but just nowhere near as popular. Literally every insurance company feels like they re-rate every year. So it's been good writing insurance, a lot of insurance in recent times because we know with every single client we tell them about re-rates and how they work and that they're going to happen. And so it does make... Although, every client forgets everything we say in an advice meeting. Every advice meeting gets forgotten. But it does make that next conversation a little bit easier to go, hey, we did talk about this. Like insurers have, 3 mechanisms to increase your premiums. They get the ability to re-rate as age-based increases. And because we've got young clients, most of them have, will likely be increasing their cover over time. So basically... that's what they can do once the policy is in force. Now, the thing that I find funny is that insurance companies, they have to price the product every single year for the next 40 years. Like, there is shenanigans going on, and we'll talk about that next. But one thing I always, the insurance industry I wish we have more empathy for one another. That's my fundamental wish is insurance companies have more empathy for advisors and what we have to put up with and how we have to run our businesses and all the complexities that comes with advice. I talk to a lot of insurance people and they can sometimes underappreciate the fact that we've got to go and do this huge body of work to get a statement of advice to make a recommendation. So when you do a repricing and you give us, 2-3 weeks notice, maybe that's not enough time. So empathy from insurers to advisors, but also the other way around. Like understanding that if you asked any advice firm that if you had to put down on paper what your advice fees were going to be over the next 10 years, let alone 30 years, do you think your projection 10 years ago would have been accurate? Every advisor would say, no, of course not. Our fees have gone way higher than we ever expected.
Yeah. And things like over advice, it's the compliance that's going through the roof. For insurance companies, it's mental health claims are through the roof. It's those things that were unforeseeable 10 years ago that have now gone, all right, we need to change our model to make sure we're still in business.
I personally get frustrated that advisors pop off at insurance companies. Oh, they don't know how to price their products. They don't know all of these things. And it's not out of a lack of just not wanting to do the right thing or not wanting to price it well, with a little bit of a caveat, which we'll talk about next. It's more a factor of, as I said, if any advice business priced out their next 20 years worth of fees that they would charge an individual client, guarantee it's going to be wrong. Within a year or two, those projections will be wrong. But if you said to a client, this is our fees and it's never going to change, you're going to probably underprice it and then start becoming unprofitable.
Or you overprice it, you don't get any clients.
Yeah, exactly. Yeah. So that's where I sometimes get frustrated at advisors kind of looking onto insurance companies going, they're mugs for doing this, when it's like, well, if we lived in that environment, we would get it wrong as well, because there's no way we could price the cost to serve an individual client that is required now. So re-rates are frustrating, but I think we just need a little bit more empathy for everyone in this industry and go that, insurers and advisors want to act in the best interest of clients and getting people insured. That's one thing. The other thing that I get frustrated with is when, this comment saying that, hey, I'm outside, I don't write risk anymore, but, it feels unsustainable. Well, write risk. Help solve the problem. It is unsustainable market. There's not enough lives insured. So how do we get more lives insured? Advisors start writing risk or actively refer out to a specialist firm who is. And, maybe I shouldn't be as, pop off as much as I am, but if you're not actively referring out or writing risk, then you're the problem. Don't whinge about re-rates. Don't complain to your clients. Don't get frustrated, because you try and be a part of the solution.
Most of those clients will have a need for risk, or at least part there.
Yes.
Not everyone has a $10 million portfolio and 100 clients with that. So you're probably not meeting your compliance regime if you're not referring it out or doing it, to be honest.
Yeah, I love it. Now, yes, we're attacking advisors. Advisors do the right thing. Next topic of discussion, initial selection discount. Now, this is where insurers are playing absolute shenanigans, and it is not got anything to do with repricing. But tell me, what is initial selection discounting or durational discounting?
Yeah, so it's pretty much you go to an insurance company and they'll take 20% off the price today of what it should be just to get you through the door, and over the next 4 or 5, potentially 10 years for some insurers, they'll just increase or take that discounting off, so that if you're looking in 5 years' time and you've held a policy for 5 years, you're going back to the same insurer for the same product, you're paying potentially 20% less to get that new product off the shelf compared to the one you've already got.
Yeah. Now, this is different to re-rating, where re-rating is, hey, we didn't predict this, we didn't know this, we're going to increase our pricing. This is baked in. Most insurers, some insurers these days are disclosing it on their quote, which I think is good, but it's still, again, an insurance company just saying, well, we're disclosing it on our quote, the advisor should know what they're doing, is kind of not giving enough empathy for the body of work that it is to give advice. You've got to go through quote comparisons, you've got to go through pre-assessments, you've got to then determine, okay, well, who's the right insurer? And then once you pick that insurer and you quote on that insurer's software, then you look at a discount. You're not going to then go, okay, let's redo all that work because there's a discount here. and every insurer is discounting.
And we don't have enough insurers in the game to go, well, you do really big discounts to go, you're not with us anymore.
Yeah.
And they're all doing it. So it's hard to do that as well.
Yeah. And the other thing is when you call up the insurance company or when the client calls you up and says, oh, my premiums have gone up by 20, 30, 40%, maybe in 1 year or maybe over the last few years. And you go and ask the insurance company, they'll say, well, it's in our quote projection. It actually hasn't changed. We haven't done a re-rate changing on the policy. And you go, yeah, it is in your quote, sure, but like how many advisors read those quote projections? How many advisors know this is happening? And then if the advisor market don't know that it's happening that well, how do the clients know? There was a comment, which I love this comment when it came to re-rate changes. Someone said, don't worry though, they just brought out discounts to new clients, which is the thing that I think we can squarely aim towards insurance companies that, hey, this is an issue. Now, again, let's take the flip side from the insurer's point of view. They don't get market share unless they discount. We talked to plenty of insurance company executives. That's probably my number one. We sat down with people from an insurance company this morning, and all I do is complain to them and try and think about solutions and how do we solve problems. But that's probably my number one complaint is duration discounting or initial selection discount, and that's where it is frustrating to see these re-rates and then these initial discounts for new clients. That's where it becomes a big tension of advisors. But yeah, talk to me. Why do insurers do it?
They need to get money in, basically. As we said, there's more people leaving the industry in terms of lives insured than people coming in. If they're not up front and with their premiums, that's where most people are shopping first. It's hard to be looking at a policy that's 20% more expensive, then going down the pre-assessment path, and they're pretty similar. Some advisors will be like, well, a 20% discount compared to an exclusion, we're probably going to take the 20% discount plus an exclusion than something that's coming through at standard rates. So they price it up and everyone does it, and then you keep fighting your way to the bottom of the barrel. Yeah, it's hard to unwind it.
And yeah, if you talk to any insurance company actuary, they will all say that we have to do it or else we don't get business. And if we don't get new lives insured, then we have to re-rate even more. So it is this downward spiral that APRA and ASIC have come out and said, hey, we don't love these, but they're not doing anything about it. They're pretty hesitant to actually do anything because at the end of the day, insurance companies can price what they think appropriately. And the argument from an insurance company's point of view is, well, underwriting today, you're the lowest risk today as soon as we underwrite. As soon as we go 2, 3, 4, 5 years down the track, you're actually higher risk because you're more likely to have a health event. And so if we re-underwrite you, we want to give you a discount for re-underwriting. And that's their kind of philosophy around discounting.
That's how they sell it to us.
Yeah, my view is like if it wasn't like this straight 5% every year for 5 years in a row, that's clearly just a way to just boost their sales targets. There are some insurers who do a little bit more like, hey, we will base these discounts based on claims experience and based on underwriting duration, which makes a lot more sense. So back to the main topic of today's discussion, Zurich's creative pricing. So big news this week, Zurich came out and have done a repricing for a new pool of customer. But before I talk about that, I want to talk about some creative pricing that Zurich did probably 6 to 12 months ago that I don't think most advisors would be aware of that they did it. But they did some pricing mechanisms with their TPD policy. And the reason why I don't think most advisors know it is because when it first came out, the sales team, the BDMs didn't know about it until we addressed it with them like, hey, what is going on here? So talk to me, what did Zurich do, a few months ago with their Zurich pricing?
Yeah, so it was about 12 months ago. They changed their TPD and how they work off the income ratios from what your income is and how long you are till retirement age. And basically saying if you're over a certain limit of income replacement ratio, we're going to actually charge you more for it. Now, most insurers, you'll get to a cap like TAL. The TAL software, you put in, say, a 50 grand income and you're age 35, it will let you take out $1.5 million of cover. And the quoting software won't allow you to quote any higher. Zurich's quoting software may have, let's say, the same mechanism. That's $1.5 million. But if you want to put in $2 million, they'll actually let you quote it, but that extra 500 grand on top will cost you far and away more than what that first 1.5 million would cost.
Pricing's not linear, but let's just assume it is linear when you increase the levels of cover. With the Zurich's TPD, it became linear until a point where they determined that you're over-insuring a client's TPD, and then it exponentially increased the cost of that additional cover. So, and the reason we worked it out is because we did some alternative quotes, and basically I think a client, I said, can I get more TPD? And then we got them more, and proportionally the premiums went crazy high. And so
it gets funkier again. If you have income protection and TPD on the same quote, your replacement ratio gets less because you're getting it in your income protection. You take off your income protection, your benefit gets higher before you start getting proportionally raised through the roof.
Yeah.
You can actually apply for both separately and they won't charge you for it. It becomes a bit of a mess pretty fast.
And let me just touch on that to explain it, because don't expect all people watching this to be hardcore riskies, but effectively, the way insurers look at TPD is the higher sums insured, the more propensity you are to claim. That's their data. Their claims data says if you've got $1 million worth of TPD, you're less likely to claim on that than a $2 million. Now, theoretically, everyone who is TPD should claim, like regardless of your sums insured, you should claim at the same rate, because the TPD pool should be the exact same, but it's not. There is a higher propensity to claim for higher TPD. That's why they're talking about TPD sustainability. That's why they have issues. That's why they do caps on TPD. So there's that. That's the reason for it. But yeah, what you just said is if you took out a TPD policy or lump sum cover only and you had that $2 million TPD, they wouldn't price it. But if you had that income protection as well, then they will look at what is your disability
pool of income.
Yeah, pool of income. Well, income protection plus disability. So effectively what we did and what we talked about doing is going, well, okay, let's just apply for the lump sum cover. And then once we're almost at the end of, because TPD gets underwritten the same as income protection, once we're at the end of the application, we'll just go, all right, let's just take a standalone income protection policy and add that to the application. And they're on separate quotes, they're priced, so the TPD doesn't get jacked up. And the team at Zurich are like, yeah, you can do that. There's literally nothing stopping you from doing it. And you get a better pricing than if you bundled it all together. Look, I understand why they're pricing it. A little bit shenanigans. It was a little bit of a confusing thing that we picked up. And then the sales team didn't know that it was a thing.
Yeah, and it's hard to know. When you go with TAL and do their quoting software, it tells you, here's your limit. You go to your underwriting because I need a little bit more because maybe my 50 grand income and my partner makes 300 grand, we've got a $2 million debt. Maybe we do need to go a bit higher. And they go, yep, that's all good. And we go and get a quote from there. But Zurich, you just plug it in and you don't really know where that limit is.
I'm sure there's like pricing mechanisms all throughout the industry that we still don't even know. And we do this day in, day out. We talk about a drop in, people writing insurance and saying that, well, to be the solution, go and write insurance. I understand why advisors aren't, because of these things that insurance companies are doing just to make it not very simple to understand. And again, they've got their pricing pools. We don't want to, from Zurich's point of view, we don't want to just increase the whole TPD premiums. Let's only increase it if it's too high. And so understand why they're doing it, but it just increases complexity, increases frustration from the advisor's point of view. And I know there are people from Zurich who listen to this podcast and who reach out to me. And so once again, if I say anything ridiculous, send me an email. So appreciate those emails when they do come in.
Yeah. At least this one, we know it's in the quote. It's what's written on the wrapper. You're paying it at the end of the day if you're happy with that quote.
That's right. With it. All right. Now, so Zurich came out and they called a new premium class. So there's a bit of buzz going around on this. I like it. There's been a bit going on with Zurich. They bought Clearview, a bit of buzz going on there. They've brought out this new premium class. So talk to me about this new premium class. What is it? How does it work?
Yeah, Zurich have a few pans on the stove at the moment. It's pretty hot. So they have a new premium class where, let me read this one.
I've got it.
You've got it.
Which is, so someone will go into a new risk category, which is defined as one where the policy owner enters into an arrangement where someone else will have a legal or beneficial interest in the policy, such as co-ownership. that arrangement involves a business that carries a financial services business related to life insurance policies, and in connection with the arrangement, there is or may be an assessment of an insured person's circumstances, such as health assessment and statistical review, and someone other than the current policy owner could receive some or all of the benefit of the policy. So my understanding is I got to triple check this, but all of those things need to be true. It's not just one of them. So if me and Kate, if we changed ownership then to Kate owning my policy, then that wouldn't trigger the new what are we calling it? The new class, the new premium class. Why have Zurich done this? What's the purpose of it?
Yeah, so there's a business out there called iExtend that some people may know about. If you're a hardcore risky, you may know about it. You may have some clients with them. But if you're new to the market, you probably have no idea who they are. So iExtend basically take over policies for people that don't want to pay their premiums anymore or can't afford it, but still want to keep their insurances. And how they do it is they take on lives which are more likely to claim on their policies than the average person. So they send through medical tests, they do age, all sorts of stuff. And it's basically a business of, put it bluntly, profits for deaths, profits for permanent disablements, profits for illness. And they give part of the money.
I think it's life only.
Life only?
Yeah, I think it's life only. I could be wrong. Send me an email.
But they give part of it, I actually don't know the percentage, but they give a part of it to the previous owner. They pay all the premiums.
Yeah.
If they don't pass away, it's a loss for iExtend. If they pass away, they obviously get the proceeds from the life cover and palm off part of it.
Yeah, so I mean we don't have any clients with iExtend, and that's purely because of our client demographic. We've got young clients. iExtend really only work with older clients, and I've had conversations with them. I want to understand what's going on. There's a bit of innovation. I'm super interested, but effectively, someone needs to come to an advisor and say, I am cancelling my policy, help me cancel it. And only then can that advisor go, hey, there is another option here. And iExtend, and my understanding, again, send me an email if I'm wrong, is basically they will pay a proportion of the benefit to the original policy owner, but then over time that benefit comes down as a percentage. So, and then iExtend may decide, okay, actually we don't want to maintain this policy anymore, and then they can either transfer it back to the original policy owner, and so they get the full proceeds or not. And so effectively, this is just Zurich didn't mention iExtend in their release or in their market release, but effectively that's our reading of the situation is shots are fired at iExtend, and not just our view. There's other people going off on the Facebook group and in message threads that we're a part of talking about it. So why have Zurich done this?
Yeah, so what's happening is we're keeping unhealthy lives in the pool. Is basically iExtend are keeping those lives and saying, yep, we'll keep paying them because we know that over time we'll profit off them. Meaning the insurance companies are losing those lives still that are healthy, so the ones they're going to cancel but iExtend don't want to take on. But we're keeping the back end of that that claims data is getting fatter and fatter. We're going, well, if we're guaranteeing claims now, or closer to guaranteeing claims, that's skewing all the work we've done for the last 30, 40 years of our actuaries. And something they haven't priced in to go, well, someone's going to keep these policies on, we're going to have to pay. So this is their mechanism of going, we're going to have to do something. It's either we charge these clients a lot more, is what they've gone with, or we raise everyone's prices to meet that need. Yeah,
so And this is where there's some comments on the Facebook group. Someone saying, basically Zurich are out there saying we don't want to pay claims, and some people are very much against it. We're in a message thread. Let me just try and find it. Basically, talking about it. Questions of, is this legal? Can they actually do this? And then talking about it being really unpopular in the market. And just saying, I think there was a comment or a statement of saying like Zurich have said the thing, actually finally said the thing that they think internally out loud of we don't want to pay claims. Now, my view is I don't agree with that. Insurance companies are in the business to pay claims, and they pay billions of claims every single year. If iExtend make money, insurance companies have to lose money. That's the business model. The only way iExtend survives is this insurance companies lose. And so it is a big pot of money on one side against a big pot of money on the other side, and who can wait until that claim is either paid or that policy cancelled. So it effectively, the bigger I extend gets, the worse it is for insurance companies, and the worse it is for insurance companies, the worse it is for re-rates.
Yeah.
So it is very interesting dynamic. Who do we, there is kind of like this, who do we like
which horse
more?
are you backing?
Yeah, which horse do we back? Do we like iExtend? Because I personally, I like the people there. I know quite a lot of people at iExtend, and I think they're bringing some innovation into the market that I think is kind of needed. But our clients are going to be paying extra premiums because their business model succeeds. Now, if their business model fails, then our clients get a cheaper premium. It's great. The insurance companies win, but they're not going to be around for very long if they do fail. So yeah, it's complex.
Yeah, I look at the ethics of it as well, thinking, well, when you look at insurance policies, we're looking at covering mortgages, we're looking at covering incomes. Instead, now it's covering people's business profits. It's not, if they're giving, again, I don't know the numbers, if they're getting 20% of that benefit, is it actually doing anything for those clients of need?
And again, I mean, this is, I just must, I'm the youngest of 5 kids. I must just love arguing because I could argue iExtend's point of view. Well, they get 20% of versus cancelling the policy. Australia, we cancel a policy, we get nothing. So if they are dead set going to cancel their policy, but they're unwell, then they have the ability to get 20% versus nothing. And there was another comment in the group that basically, because people were saying, oh, is this even allowed? How could Zurich do this? And someone was made a mention saying guaranteed renewable products don't have the ability to change once in force. Do you think paying $1 million claim to iExtend and then the client gets $100K is a good outcome for all policyholders? How do you think that this affects the innocent policyholders who don't claim? That's right. Of course, the price goes up. So on one hand, in the Facebook group, we're talking about re-rates and how frustrating they are, but then also going, well, iExtend should be able to exist and innovate. It's an interesting dynamic that's happening, but effectively, I was talking to other people yesterday, it kind of kills their business model. iExtend, like, they've just absolutely torched a whole bunch of money, which, again, we talk about like Integrity came in the market, they set aside a whole bunch of cash. iExtend, if all insurers adopt this, they'll set aside a whole bunch of cash. Like it's not good in Australian insurance industry to have a lot of innovation just burn cash because, Clearview's just sold, so we're getting a contraction on insurers, and then all these innovative players are kind of also struggling to
make a mark.
Yeah, make a mark. So interesting dynamic. Where do you stand with iExtend? You sound like, my read is you sound like you don't like them.
Before this, I'd never really thought about the pricing side of it. And I was like, yeah, they're a great business, they get to keep it. But then when I look at it, step back a little bit, I was like, again, I know a few of the guys there. I've met them all, lovely guys. But as a whole, I don't love the idea of profiting off people dying and the families that should be getting the money or need the money actually getting it.
Yeah, it's interesting because one thing that this pricing pool doesn't impact is if that was, you or me, and my dad had an insurance policy and he was unwell, there's nothing stopping me from being the policy owner and paying those premiums and going, well, if, as 5 kids, we can all contribute evenly and then we know there's going to be a high inheritance. That scenario doesn't impact that pricing pool. So if clients are good for iExtend, then as advisors who are maybe working with them, you can maybe pivot into do you have children who maybe want to maintain this policy? Does it make sense for them? But yeah, pricing is the insurers are barely making money. We're re-rating all the time, and so I'm a little bit surprised because I can't imagine iExtend have I can't imagine Zurich have huge exposure with iExtend. Maybe they're just projecting forward and going, okay, if we let them run for another 5 years, then it becomes a real big issue.
Nip it in the bud early, basically.
Yeah.
How do we get out of it?
We write more business. That's really like how we go as an industry. How do we solve a lot of these problems? Because a lot of these unhealthy lives, they're getting priced out of insurance, not even with these pricing mechanisms, but just naturally re-rates. They're pricing older clients who have health issues. The only way we can get out of the death spiral that life insurance in Australia is getting more lives insured. Now, you know my views on general advice. I don't think that's the solution. New class of advisor, I'm very positive on what that looks like, whether it's only insurers being able to hire a new class of advisor, I'm okay with that. But essentially, any advisors out there listening, write more insurance. Don't just say, oh, that's not my expertise or it's unprofitable. If you're whinging about an insurance company not making enough profit off your clients' premiums, then you start taking some hits and don't make money off insurance. So start writing it or refer out. Like that's where, and like, you know, there should be 20 Skywealths in the market where writing 1,000 policies a year because there's plenty of opportunity. It's just advisors sometimes they sit on their 500 clients who are just paying their renewals and that just kind of tapers off. You know, we talked to someone yesterday who that was kind of there, well, they don't really refer out, they don't really write business, but they're not really willing to, you know, sell off those policies. So another advice firm can try and, you know, help those clients maintain those policies or rewrite them if it makes sense for the clients. So that's my view. We just need more insurance policies being set up. Any contrarian view from you?
No, I was leading the horse to water. Yeah. And the horse definitely drank.
Yeah, exactly. Awesome. Well, this has been a good discussion. We'd love to hear your thoughts. If you're watching this and you totally disagree with me, please send me an email, phil@sky.com.au. If you disagree with Trent@sky.com.au. Thanks, Trent. Appreciate having the discussion about pricing shenanigans.
Pleasure. It's all mine.
All right, thank you very much for watching. If you did enjoy this, we have a full playlist that you can see anywhere you're listening to this now. And I've mentioned a few times, we do have a Facebook group where people are discussing all things risk insurance. So jump in there on the My Risk Advisor Facebook page.